The same bank that paid $920 million in federal fines for manipulating the silver market, Sarcastic, is now reportedly sitting on one of the largest long silver positions in history. That is not speculation. The fine is documented by the U.S. Department of Justice, the CFTC, and the SEC. The position data comes from CFTC Bank Participation Reports and exchange data aggregators. The bank that spent 8 years suppressing the silver price has switched sides. And while that was happening, curious, the Federal Reserve Bank of New York quietly removed the aggregate limit on its overnight repo operations in December 2025. Their exact words: operations will no longer have an aggregate operational limit. On December 26th, Christmas morning, the NY Fed delivered a cash operation to financial institutions while markets were closed. 3 documented facts: federal court records, exchange data, central bank public statements, exhales sharply, all pointing toward the same silver market. Today, March 23rd, we are going to follow where those facts lead, not with opinion, with data that is already filed, already public, and already telling a very specific story. Let us start with the documented legal record, because before you can understand what is happening in silver right now, you need to understand who has been sitting at the center of this market. From at least 2008 through 2016, JP Morgan, through numerous traders on its precious metals desk, placed hundreds of thousands of orders to buy or sell gold, silver, platinum, and palladium futures contracts with the intent to cancel those orders prior to execution. For over 8 years, traders on JP Morgan's precious metals and U.S. Treasuries desks engaged in separate schemes to defraud other market participants that involved thousands of instances of unlawful trading meant to enhance profits and avoid losses. On September 24, 2020, JP Morgan entered into a deferred prosecution agreement with the Department of Justice and agreed to pay a total criminal monetary amount of $920,203,609 in criminal monetary penalty, criminal disgorgement, and victim compensation. That settlement is the largest precious metals manipulation fine in U.S. regulatory history. 2 traders, Michael Nowak and Greg Smith, received federal prison sentences in 2023, and JP Morgan was not alone. 7 other banks paid their share of what totaled $127 billion in enforcement actions across DOJ, CFTC, and SEC actions. Scotiabank paid $127.5 million, HSBC paid $76.6 million, Deutsche Bank paid $75.5 million. Bank of America, UBS, Goldman Sachs, and Morgan Stanley paid additional amounts. When people say silver is manipulated, they are not wearing tinfoil hats. They are citing federal court documents. Now here is where the documented legal record connects to something even more analytically significant. By late 2025, the narrative around JP Morgan's silver position had completely reversed. Market data sources and CFTC reports indicate JP Morgan held substantial silver positions as of late December 2025, with COMEX proprietary and brokerage positions estimated at approximately 196 million ounces and approximately 517 million ounces held in SLV ETF custody. Important caveat: the CFTC does not report specific positions, and no bank will ever come out and tell you directly what they are doing. These figures represent aggregated estimates from market data sources and cannot be declared with absolute certainty. What can be said with confidence? JP Morgan's dramatic reversal from a massive short position in paper silver contracts to a net long stance between June and October 2025 represents a significant shift in the dynamics of the physical silver market, effectively removing the greatest long-standing force of relentless downward price pressure. The timing of that flip is the most important single institutional data point in the story. It happened right before silver hit its all-time high of 121.67 on January 29, 2026. Then silver crashed 38% in under 30 hours, and JP Morgan delivery data from the exchange showed the bank issuing contracts near the precise intraday low of that crash. Now the structural event that most Western financial media treated as a footnote. January 1, 2026. China reclassified silver from an ordinary commodity to a strategic material. Only 44 companies received authorization to export silver over 2026 and 2027, establishing government gatekeepers over approximately 121 million ounces of annual exports, representing 60 to 70% of refined silver traded globally. To qualify for a license, a firm must demonstrate annual refined output of at least 80 tons and credit lines above $30 million. China exported over 4,000 tons of silver in the first 11 months of 2025, while importing only 220 tons. They were a massive net exporter, and they turned the tap off. Simultaneously, their own domestic buyers were paying $8 to $10 per ounce above world prices to keep metal inside the country. And Elon Musk, the man behind Tesla and SpaceX, Companies that depend heavily on silver for EV battery contacts and satellite semiconductors commented publicly. His exact words, "This is not good. Silver is needed in many industrial processes." The man running the largest EV company on Earth registered public alarm about silver supply. Nobody was listening. Now the sequence of events that nobody has fully connected in one place. Silver peaked at $121.67 on January 29, 2026. The following morning, three things happened in tight sequence. The London Metal Exchange reported a pre-market glitch that delayed the start of electronic trading, at the exact moment when the London Open would have provided liquidity support for long positions. HSBC, one of the banks that paid manipulation fines, simultaneously reported its own systems down, and the CME raised margin requirements on silver futures, forcing every leveraged long trader to either post substantially more capital immediately or liquidate. Margin increase, simultaneous liquidity provider outages, forced selling hitting a thin market. Silver dropped from $121 to approximately $75 in under 30 hours, a 38% collapse, the worst single-session decline for silver since 1980. Three events, tight sequence, maximum damage to leveraged retail longs. Now here's the context that makes that sequence more significant. In accordance with the FOMC implementation note issued December 10, 2025, standing overnight repo operations will no longer have an aggregate operational limit and will be conducted in full allotment format. The Federal Reserve removed the cap on emergency bank liquidity on December 10th. On December 26th, Christmas morning, the New York Fed delivered a $17 billion cash operation to financial institutions. And on December 28th at 5 p.m., when banks were closed, the New York Fed infused one or more Wall Street banks with $34 billion of cash. After going more than 5 years with little to no cash infusions, there was suddenly a spate of them, three of them gigantic, beginning on Halloween when the NY Fed injected more than $50 billion into one or more unnamed banks. The Fed's own position, the FOMC eliminated the aggregate $500 billion daily limit on standing repo operations that had been in place since their introduction. Someone, or multiple institutions, needed substantial liquidity exactly when silver was making its most violent moves in 46 years. The identity of those institutions has not been publicly disclosed. Ask yourself why the Fed went to unlimited cash provision in December 2025, and ask why nobody in mainstream financial media has connected those repo operations to the silver crash that followed 3 weeks later. Now the counterargument, because this channel does not present one side and call it research. The Bank for International Settlements, the central bank of central banks, published a direct examination of the silver crash in its March 2026 quarterly review. Their conclusion was not manipulation. Their conclusion was mechanics. Retail investors created bubble conditions through ETF buying never matched by institutional commitment. Leveraged silver ETF funds rebalance daily to maintain fixed leverage ratios. When prices fall, they sell, automatically, amplifying the move. The leverage rebalancing multiplier in silver ETFs doubled over the course of 2025. When prices reversed in late January, the daily rebalancing mechanics automatically amplified the selling. Margin calls cascaded, ETF premiums over NAV flipped to discounts consistent with retail panic. The BIS framed this as the market functioning exactly as designed. Institutional investors maintained stable positions. Smaller retail participants were forced to reduce positions fastest. That argument is internally consistent and data-supported. It is also the explanation that requires no one to have done anything illegal. Whether you find that comforting or suspicious probably depends on what you think about the $920 million that was paid 4 years ago. Now what was happening in the physical market while the paper price was crashing? All of 2025 combined settled 474 million ounces in physical delivery compared to 203 million ounces in 2024. The number more than doubled in a single calendar year. December 2025, 65 million ounces delivered, an all-time record month. January 2026, 49.4 million ounces, more than 7 times the prior January average. February 2026, 33.5 million ounces, the highest February on record. Physical buyers were not reducing delivery demands. They were accelerating them. The paper price crashed 38%. Physical delivery demand hit records. Those two things cannot both be true in a market with adequate supply. At least one of them is telling you something the other is trying to hide. One more structural force most analysis is not connecting. Basel III capital rules came into full effect on January 1, 2026. European banks were forced to replace unallocated paper silver holdings with allocated physical metal to meet new liquidity requirements. Unallocated silver, the form in which most London silver has historically been held, is essentially a promise backed by pooled inventory. Basel III said that promise was not good enough anymore. Banks scrambled to source physical bars. The Sprott Physical Silver Trust doubled its capital raise program to $2 billion in January 2026, enough at then-current prices to acquire approximately 18 million ounces of physical silver, representing roughly 16% of total COMEX registered inventory in a single institutional move. That is not a retail trader making a bet. That is a $2 billion institutional statement about what physical silver is worth relative to paper claims against it. The demand backdrop underneath all of this is not speculative. Each photovoltaic cell in every solar panel contains approximately 111 meters of silver, performing a function nothing else can perform as efficiently. By 2025, the solar industry alone was consuming between 200 and 250 million ounces of silver annually. Electric vehicles consume an additional 40 to 60 million ounces per year. Samsung has patented EV battery technology requiring approximately 1 kilogram of silver per vehicle. AI data centers, 5G infrastructure, medical devices, defense systems. Each Tomahawk missile contains roughly 500 ounces of silver. Nuclear reactor control rods lock in silver consumption for 40-year operating lifetimes. And here's the fact that separates silver from every other commodity. The silver consumed in a solar panel cannot be economically recovered. Recovery costs run $150 to $200 per ounce, often exceeding the market price of the metal itself. That silver is gone permanently. Every ounce into a panel, battery, missile, or semiconductor is permanently removed from the above-ground supply pool. It will never come back. The bear case deserves full precision. The BIS mechanics argument is internally consistent and cannot be dismissed. COMEX has managed delivery pressure for decades. The exchange has tools, higher margin requirements, delivery procedure changes, and in extreme scenarios force majeure cash settlement at a price of the exchange's choosing. The Hunt brothers found this out in 1980 when COMEX went to liquidation-only mode. As long as most futures traders accept cash settlement rather than demanding physical delivery, the paper market continues setting prices. The JP Morgan position estimates are aggregated data, not a single primary source document. The CFTC does not report specific institutional positions. Anyone presenting the 713 million ounce figure as confirmed fact is overstating the available evidence. The Fed's repo operations, while significant in scale, may reflect normal year-end seasonal liquidity demand rather than systemic institutional stress. The structural case is the strongest it has been. That does not mean the paper price cannot move lower. Understand the difference between the documented evidence and the inferential conclusions drawn from it. Here's the documented picture as of March 23rd. $920 million in federal fines, paid by JP Morgan for 8 years of silver market manipulation between 2008 and 2016. 7 additional banks, paying a combined $1.27 billion across enforcement actions. JP Morgan's position shifting from short to estimated long. Approximately 196 million ounces COMEX plus 517 million ounces SLV, per aggregated market data. China reclassifying silver as a strategic material on January 1, 2026, restricting exports to 44 approved firms, severing 60 to 70% of global refined silver supply from Western markets. 474 million ounces of physical silver delivered through COMEX in 2025, more than double the 2024 figure. The Fed removing the aggregate limit on overnight repo operations December 10, 2025. 17 billion and then 34 billion in repo operations in the final week of December 2025. Basel III forcing European banks to replace paper silver with allocated physical. Sprott raising $2 billion to acquire physical silver, 16% of COMEX registered inventory in a single move. Silver permanently consumed in solar panels at 111 per cell, unrecoverable at any current price. None of those are theories, all of them are documented. The paper price on your screen right now and the structural reality in the physical market are telling two different stories. The data says they cannot both be right indefinitely. Watch which one moves toward the other. Verify everything using the sources listed below. Invest with logic, not hype. Market Crux, signing off.